I'm Ryan Lightfoot-Brown of Fund Calibre. We're joined today by Tom Slater, the elite rated manager of the Scottish Mortgage Investment Trust. Thank you for joining us, Tom.
Thank you for having me.
I noticed you invested in Lyft recently. Was that as part of the IPO? Is that one of the private companies that you can invest in?
Well, our investments in private companies started back in 2012 in real earnest scale. And the reason was that we saw this trend amongst the companies that we owned, that they were able to grow with very modest capital requirements. They didn't have to go out and buy servers and software and infrastructure as companies had in the past. They were able to rent these things. And they were able to get distribution into the billions of smartphone users that you have today. And when you have that combination, companies are able to achieve really breakthrough scale without seeking a lot of capital. And what that means is that they don't have financial investors controlling their boardrooms. They're staying private longer. They're thinking about moving to public markets on a timescale to suit themselves. So for us, to maintain our opportunity set, we felt that we had to go into private markets to find some of these attractive companies at an earlier stage in their growth. Now, Alibaba's first trade in public markets was at a $200 billion valuation. So $200 billion of value had been created in the private markets. And we want to get access to that value creation for our shareholders. We think we're able to do that in a really different way. So at the same sort of fee scale that they're paying for public market investments, these type of companies would not be available to many of our shareholders at anything like the type of fees we're able to offer them. So we think that creates enormous value for shareholders if we can find these exciting growth companies at that early stage of their development. So to the specifics of Lyft, we invested in Lyft 2 or 3 years ago. We saw the potential of the ride-sharing market, and also the way that Lyft was growing in the US at the expense of its larger rival Uber. And you've got a management team there with a real vision to drive that business forward and build it as a large company for the long term. So we invested a couple of years ago. We've added since, and then we bought some more in the IPO. And actually, that's becoming a really common theme in the portfolio. Actually, we now have a number of holdings, which are often quite large in the portfolio, that started as private company investments. And then where those companies have listed, we've taken the opportunity to add to the position. We don't look at listing as an opportunity to exit. Instead, we just want to own really attractive businesses for the long term, regardless of their private or public status.
And speaking of the privately listed companies, you can invest up to 25% of the portfolio, which is quite unusual. How do you go about finding these unlisted companies? How do you find the next Lyft?
Well, I think the important point to understand about some of these private company investments is that we aren't trying to become venture capitalists. Instead, for us, it's about finding breakthrough businesses that we think have achieved some degree of scale, which actually have a big opportunity, and we're not sure at what point in their life cycle and in the exploitation of that opportunity that they're going to move to listed markets. We think we can analyze them with the same frameworks, the same structure that we would analyze any listed company. Now, I think when you start to look at some of these companies, what you see is that they have ready access to capital in private markets. There's a lot of capital out there. So you have to think really carefully about what do you bring to these companies other than capital. And for us, what we see is that these management teams think really carefully about the ownership of their business. They want to find shareholders who have a time horizon similar to their own. They don't want to be spending their entire time explaining what happened in the last 12 weeks or what's trading in the 3 weeks since the end of the quarter. And so they look to public markets and they look at how people behave. They see we've been one of Amazon's top 10 shareholders for more than a decade. We see that we've been very long-term shareholders of Illumina or Baidu or Tencent or Alphabet. And they say, well, those are the type of shareholders we want to have when we move to being a listed company. How do we start a relationship today? And so, unlike many venture capitalists where access is one of the big questions for them, for us, it's how do we sift through the hundreds of opportunities that come in every year. And we own very few stocks in listed markets out of a very big universe. And the same is true in private companies. And the challenge, if anything, is how do you filter the number of opportunities, not where do you find the most attractive ones.
And very recently you invested in Ant Financial, which is linked to Alibaba, and it's now up in your top 10 holdings. How have you been able to add so much so quickly, and what's the reasonings behind all this?
Yeah, so I think it comes partly back to this question of what we're trying to do with some of these unlisted companies. And the answer to that is we're trying to find the companies that have the opportunity to be hundreds of billions of dollars of valuation, the companies that are going to drive the change and the new structures of markets over the coming decade. And I think for us, Ant really fits that criteria. The online payment market in China is much more sophisticated than it is anywhere else in the world. That market has bypassed, a lot of the traditional infrastructure we have in the West. There are no ACH rails. There's the credit card networks have relatively limited penetration, and instead they've jumped directly to paying for things either online or via smartphones. And Alipay is the biggest asset in the market. It's part of the Ant Financial. It's part of the Alibaba group of companies. So we have some exposure to these assets through the listed holding in Alibaba. But we think actually that this entity has the opportunity to create real value. So they can use the huge amounts of data they have about the people who use the platform to lend really effectively with a deep knowledge of the credit characteristics of the people that they're lending to. They can create savings products very readily. So their money market fund attracted hundreds of billions of dollars of assets shortly after they launched it. There's lots of people without access to traditional banks or banking infrastructure in China who are never really going to need that infrastructure because they can use these online financial products. So we just see it as one of the companies that has one of the biggest opportunities in the world. And for us, we're not interested about whether it's a listed company or an unlisted company. That doesn't matter. Does it have a big opportunity? Do you have brilliant management who are committed to executing on that long-run vision? And in Ant Financial's case, absolutely you do. And is the valuation such that you think if you're right about this company, you can make several times your money? Because I think that's one of the things that drives returns in stock markets. It's not about the return of the average company. It's about the contribution of a very small number of exceptional companies. And our job for Scottish Mortgage shareholders is trying to identify those companies and own them for very long periods of time.
And as such, it's one of your top 10 most highest conviction positions.
Yeah, well, I think when we look at some of these private companies, what we don't want to do is end up owning hundreds of them in a relatively concentrated listed portfolio. Instead, we want to really build deep relationships with a small number of companies that we think can can create large amounts of value. Now, to stay with the specifics of how do we feel about having an unlisted company as one of our largest holdings? Well, we invested in Ant Financial at a company valuation of $150 billion. This is a very large, very established business with cash flows, with huge revenues. It isn't a startup. It doesn't have that existential risk attached to it that with a very early stage company. It's much bigger than many of the listed companies that we own. So if there are challenges around owning an unlisted company in that sort of size, it's really the operational ones. How do you ensure that the valuation in your books accurately reflects the valuation of the company? It's not investment risk, we want to have our largest holdings as the companies that we think have the most long-term potential. Full stop. Listed, unlisted, doesn't matter.
And sort of going on from that, being an unlisted stock, how did the sort of conversation with your board of directors go about moving so much into it?
Well, the board of directors have been really, really valuable to the progress we've made in Scottish Mortgage over the past 10 or 15 years. They've really helped us to think carefully about what it is we're trying to do for our shareholders, what it is that's different about what we do, and then help us to focus on that task and to not worry about the things that don't add value. And so, they've helped us move to having a much higher active share in the portfolio, really helping us to have conviction in backing our best ideas, really being clear on the proposition that we are trying to be the part of somebody's portfolio that achieves long-run capital growth, that we accept volatility in the short term because we don't think volatility is the same thing as risk, in order to drive those long-term capital returns. And that's the job that we try to do for our shareholders. We're not trying to be everything to everybody. We think it's better to focus on the thing that you can do well. And I think that takes you directly to your question of unlisted companies. We think we are able to do this in a way that is difficult for other people to emulate. It's because of the relationships, because of the reputation that we've built as long-term custodians of companies, that we get the opportunity to make these type of investments. It's something that's hard for other people to get access to do. We have a fund structure which is really valuable in trying to do this, because we're not an open-ended fund. We don't run the risk of people withdrawing their money and us being able to fund it because the company is private. We aren't a limited life fund like most of the venture capital funds, where they can at most hold a company for 10 years. The Scottish Mortgage has been around for more than 100 years. Effectively, it's permanent capital. And so we have a time horizon and a liquidity profile that's really matched to investing in these companies. And so if you have those advantages, that they're in line with the strategy of what you're trying to do, long-run capital growth, and the board has really supported us in moving forward with that proposition, making it attractive to underlying shareholders, pushing us to make sure we did it on a almost unique cost basis, within the framework of ongoing charges that we already had, and indeed pushing that lower, even as we've done it. So we find the board's input really, really valuable. They are really high caliber people that think about a lot of the same issues that we do, but not with a direct investment perspective. And that is invaluable to us as we try to work through the issues ourselves as managers.
And when you're engaging with the board, what sort of things do you talk about?
Well, what the board are very good at is thinking about the proposition from the point of view of our shareholders. Is what you're doing adding value for shareholders? Is it what they're expecting you to do? And that manifests in many ways. So, for example, issuance of stock and buybacks. We have consistently bought back shares, if you look at the past decade, and as we sought to match supply and demand for shares in the market. And then in the past 2 or 3 years, that's moved to issuing stock, because we don't want the shares to trade at a significant premium to their asset value, because we think that's unhelpful anyway. So they've really helped us develop our thinking on how we run that liquidity program and try and keep the share price and the net asset value as close together as is possible. They help us develop our thinking on individual investments, not by sort of looking over our shoulders and saying, well, aren't you wrong about this, or haven't you thought about that, but helping us to think through some of the issues and the big trends that a lot of these companies are facing. The big online internet commerce companies, are increasingly operating in a more regulated environment. How do you think about that? What size should these positions be in the portfolios? Working through some of those questions with them is really valuable. Thinking about risk. What is risk in the context of Scottish Mortgage? How should we measure it? How should we monitor it? I think the board are really, really helpful from that perspective as well. And then we've talked a bit about the unlisteds, and one of the key board jobs of the board is to sign off on the valuation of our unlisted companies. So helping us develop a really robust, independent process for valuing these instruments, and auditing that process is really valuable.
And we previously spoke about China. Do you have any concerns over sort of the escalating trade tensions between the US and China? We recently saw the disagreement between Google and Huawei, to put it politely. What sort of your thoughts and opinions on that?
Well, I think the market will oscillate, reflecting whatever the latest update is on these trade negotiations between the US and China. I think that the US are or believe that they can strike a hard bargain with China, that they can extract terms from the Chinese which would be beneficial to them. But equally, it is exactly what you'd expect to happen when you have a rising economic power in the East, which is a challenge to the hegemony of the US state. And it seems pretty unlikely to us that any of these measures are going to significantly impact the long-term trajectory of Chinese growth. Not least because so much of it is now being driven by domestic consumption in China. So I think anybody that sort of claims they can tell you how these trade negotiations are going to play out is very unlikely to be correct. We don't try to second guess some of those big picture issues, because I think it's just a very difficult way to add value for your shareholders. Instead, it's saying, well, what are the long run trends that really matter? And some of those are actually very predictable, by the way. I can say with some confidence that I think Moore's law will continue for the next decade. That the amount of computing power we get for $1 will halve every 18 months. That software will get more advanced. That the storage capacity of batteries will increase substantially. That the speed of our mobile communication networks will get faster. There's so many of these things that are really quite predictable in the way that trade negotiations aren't. And actually thinking through what the consequences of some of these long-run and almost inevitable trends are, and who benefits in that world, is much more likely to create value for shareholders than trying to do what so many other market participants are doing, which is to bet on the fluctuations of trade negotiations or other whatever the topic of the day is next week or the week after.
Well, Tom, that's been really interesting. Thank you very much for joining us.
Oh, thank you very much.
And for more information on the elite-rated Scottish Mortgage Investment Trust, please visit fundcalibre.com.